Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at NUVL, or Nuvalent Inc. NUVL is a biopharmaceutical company that's focused on creating precisely targeted therapies for clinically proven kinase targets in cancer. Here's the barchart.com technical opinion rating for NUVL. The bar chart rating is a 100% buy with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that NUVL is well above the moving average line, so the monthly trend in NUVL is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in NUVL is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. NUVL is below the upper Keltner channel line, so NUVL is inside the buy zone. Since the trend is up, we want to buy a call. NUVL has 6 option chains to choose from. We're going to use the February 16 option chain. Right now, the Feb 16 options have 25 days to expiration. Here is the NUVL option chain for February 16. NUVL closed at 75.42 on Friday. That means any calls on the list from 40 to 75 are in the money. Let's take a look at the profit potential for purchasing the 75 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 75 call is 360 to 640. We try to enter at the midpoint, so we'll use 5 even as the buy price. Our call option calculator shows the profit potential for this call based on NUVL price changes at option expiration from flat to a 12.5% increase in price. We can see that if the NUVL stock price is flat at 75.42 at option expiration, the 75 call will lose 91.6% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying a 70 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 70 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the NUVL stock price is up 1%, the 70 call will lose 23.3% of its value. We want that to be break even or better, so the 70 call does not meet our requirements. Let's see if the 60 call will work. The bid-ask spread for the 60 call is 1370 to 1790. We try to enter at the midpoint, so we'll use 1585 as the buy price. The 60 call works. If the NUVL stock price is up 1%, the 60 call will make a 2% or $32 profit. That's better than break even, so the 60 call is the one we'll buy. The call option purchase calculator also shows that if the NUVL stock price increases by 2.5%, the 60 call will make a 9.2% or $146 profit. If the NUVL stock price increases by 5%, the 60 call will make a 21.1% or $344 profit. If the NUVL stock price increases by 7.5%, the 60 call will make a 33% or $523 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the NUVL stock price does not make the expected move up and it remains flat at expiration, the 60 call would only lose minus 2.7% or minus $43 compared to the minus 91.6% or minus $458 loss for the 75 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the NUVL Feb 16 65 strike call and sell to open the Feb 16 70 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 65 call for $11.60 and sell the 70 call for $8.05. $11.60 minus $8.05 equals $3.55. So the entry price or debit cost for the spread is $355. The call option spread analysis calculator picture shows that the spread will make a 40.8% or $145 profit if the NUVL stock price declines by 5%, remains flat, or increases in price when the options expire. If NUVL is down 7.5% at expiration, the trade will make a 34.2% or $121 profit. Creating the debit spread will allow us to collect an $805 cash credit to our brokerage account for the sale of the 70 call. As we said on the previous slide, this reduces the cost of entering the spread to $355. Here's a note regarding earnings reports. The next NUVL earnings report is scheduled for Feb 13. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the NUVL Feb 16 60 strike call for $15.85. We also reviewed a spread. Spread said to buy to open the NUVL Feb 16 65 strike call and sell to open the Feb 16 70 strike call at a debit of $3.55. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.